If you want to buy a house and you want to save for it, there is an extremely tax efficient way of doing this. So let's assume that you're able to set aside some money every month. You can deal with the risk of stocks or equity mutual funds. So you can do an SIP every month in one of those. And eventually, your goal is to buy a house. The tax efficiency comes in because of Section 54F. This section says that if you sell any capital asset uh, and you are liable to pay long term capital gains tax, but you reinvest the sale proceeds in buying a house, then you don't have to pay the tax. So let's go back to this, let's say, equity mutual fund that you bought. Let's say that you invested 1 crore, that has become 2 crores over time, which now you think is enough to buy a house. So you sell it. Normally, you would have to pay a tax of 10% on the gains. So you would have to pay 10 lakhs in tax. But because of Section 54F, you can invest this amount in a capital gains account scheme, which you have to do by the end of by 31st of July, and within 2 years of selling the mutual fund, you have to buy a house. There are two big conditions here. One is that you can't already own two houses. If you already have one house, that's fine, but if you have two houses, then you can't get the benefit of Section 54F. Uh, Second condition is that the cap on this exemption is 10 crores. So you can't buy a house more than 10 crores to get the exemption. But for most middle class Indians, 10 crores is quite a large limit. So you don't have to do a lump sum. Also think of this as an SIP. Even if you can set aside 50,000 rupees a month, and let's say that you wait for 10 years, and let's assume that your return was 12% compounded, you would have accumulated a 1 crore corpus, which you would then reinvest into buying a house. This benefit is not available through any other kind of investment. So if you do a bank FD, you're not going to get this benefit. If you do a debt mutual fund after 1st April 2023, you're not going to get this benefit. This is only for really affecting stocks, equity mutual funds, etc. So if you do plan to buy a house, this is a pretty tax efficient way of doing that.